Welcome back to Options Trading for Beginners. In our first two videos, we laid the groundwork by explaining call and put options, and then dived into the concept of the option premium. Today, we're going to get precise and talk about the exact details you'll find in every options contract you look at. Understanding these core components is absolutely crucial before you even think about placing a trade. Underlying asset. Every options contract is tied to an underlying asset. You'll often see options on popular companies like tech giants, well-established blue-chip companies, or even broad market ETFs that track the entire economy. Beyond these, you'll find contracts on gold, crude oil, or natural gas in the commodities markets, major currency pairs like euro-dollar in the forex market, and even contracts that pay out based on temperature fluctuations or rainfall. The contract will clearly specify which asset it pertains to, usually by a sticker symbol or a unique identifier. This ensures you know exactly what you have the right to buy or sell. Next, let's clarify the option type. Every contract specifies whether it's a call option or a put option. As we discussed in a previous video, a call gives you the right to buy and a put gives you the right to sell. While calls and puts are the most common, it's worth noting there are other, more specialized categories of options, such as barrier options, like knockout options, and other more exotic options, which we might explore in a more advanced lesson later in this series. Then we move to the strike price. We've mentioned it before, but let's be clear. This is the predetermined price at which the option holder has the right to buy or sell the underlying. This price is fixed at the moment the contract is created and does not change. Following that, we have the expiration date and, importantly, the expiration time. The expiration date is the absolute last day the option contract is valid. After this date, option simply ceases to exist. It's also critical to know the expiration time, as markets around the world will have specific cutoff times for trading and exercise on the expiration day. Understanding both the date and time is vital because an option's value is heavily tied to how much time it has left, a concept we'll explore in depth with theta. Finally, it's essential to remember the contract multiplier. While an option's premium is quoted per unit of the underlying asset, the actual quantity represented by one contract can vary significantly based on the asset class and exchange. For example, one standard equity options contract in the US typically represents 100 shares of the underlying stock. However, for currency options, one contract might represent 10,000 units of the base currency, or for commodity options, it could represent a specific number of barrels, ounces, or bushels. Understanding these precise contract details, the underlying asset, option type, strike price, expiration date and time, and the contract multiplier is fundamental. These are the fixed specifications that define the agreement. In the next video, we'll build on this by discussing how an option's price behaves relative to the strike price through the concept of intrinsic value and moneyness. Don't forget to subscribe so you don't miss it.